let's bring on our guest. You can see him up here with me. Thomas Hayes is the chairman and managing member of Great Hill Capital. Thomas, how are you?
I'm doing great. Great to be with you, Paul.
Yeah, it's good to be here. It's a good day in the markets. You know, look, I mean, it's not a terrible day. Kind of an active day. Let's put it that. I forget where the indexes are, but an active day. Yeah. So let's talk about that retail sales this morning. Good release, good report. I mean, good numbers if you're interested in seeing a growing economy. Means different things, though, for the markets. Why do you think markets were mixed on this piece of news this morning?
Well, I think it's another piece of very strong data that doesn't give the Fed much cover if they want to pause. And the market was anticipating that maybe one more 25 basis point hike and the Fed could pause. Those expectations got adjusted, first with the jobs report being so strong and now with retail sales. But if you look at retail sales, a lot of it was skewed towards new autos, where there's been a 2+ year backlog of people wanting to get new cars, but were limited by the semiconductor chip shortage, which is now alleviated. And I think you're going to see a really strong year for new cars, and I think you're going to see a very weak year for for used cars. And the reason being, financing has gone up. For used cars, there's no way around it. For new cars, we're going to start to see more and more dealer incentives. So, but the mixed response was, on the one hand, the Fed now has no cover to pause at the next meeting. They'll probably have to go maybe 2 more 25 basis point hikes. On the other hand, the market's saying, wait a second, this economy is actually strong. Maybe we're not going to have a soft or a hard landing. Maybe we're going to have no landing at all because people still have jobs, people still have money, people are still spending. And I think that's something to strongly consider here.
Yeah, I wanted to ask you about that specifically, and you kind of got to it. But obviously, retail sales, consumer spending is the major part of the economy. So you see this report, and it comes in much. I know it's a 1 month, one data point, but if you kind of string things out, what are these retail sales reports telling us about the economy?
Well, it's saying that, first off, it's strong. And the other thing that the Fed now has to take a look at, there's 2 ways they can normalize wage growth or average hourly earnings. One is what everyone thinks that they're out to do, which is collapse the economy, get a lot of people to get fired, then you won't have competition to labor and everything will be fine. There was one key line in the non-farm payrolls report that didn't get quite enough coverage, and that was labor force participation rate, now tied for a post-pandemic high at 62.4. So on the one hand, they can crush the economy to keep wages subdued, or now that people are running out of savings, which people view as a negative, I view it as a positive. More and more people are going back to work in record numbers. So if we get another, if we get up to 63% labor force participation rate, and, 1 million some odd people entering the labor force with 2 jobs available for everyone looking, number one, the jobs are going to be filled. Number 2, that's going to keep wages normalized. And I think your biggest risk, a friend of mine, we had a little Super Bowl get together last minute at my house this weekend. Friend asked, what do you think about short-term bonds? I'm paid, almost 5% to wait. And I said, a lot of people are saying that. A lot of people are thinking in that way. And I always look when the boat gets very, very crowded to one side. Where's the pain? Well, there's no pain if rates go higher than expected because they're short duration and you get taken out within a year. There's no pain if rates go lower because your bonds will appreciate before you get paid out at maturity. So where's the pain? The pain is if you look out 6 to 8 months and what happens if you are, quote, getting paid to wait and the S&P rallies to 4,800 and you miss another 20% up move. So many people missed the move off the October lows, 18.5%. And now I think the biggest risk, the maximum pain in the market with everyone pushing into bonds, short-term bonds like you saw with the Bank of America Global Fund Manager survey yesterday, even institutions are following this trend. The only place that there's pain now that everyone's crowded into quote-unquote safety to ride out the quote-unquote storm would be if the market pushes higher against the wall of worry and people are left holding the bag. And once you miss a rally like that, you can really never get it back in the long-term scheme of things. the biggest moves in the stock market always happened off the worst conditions. We got the first leg off of October already. And based on the way people are positioning and the persistent sentiment and wall of worry, I wouldn't be surprised if we get another leg over the next 6 to 8 months.
Yeah, it's interesting you mentioned that because I noticed today when I was on the app, on the public app, that Public has a treasury offering now as well. To your point about everyone's piling in, but it makes me wonder. I talk about that for a second. Should people have should it be a bonds or stocks, mindset? I mean, it seems like your mindset shouldn't be like that. Like, oh, the market's down, I better go all into bonds, or bonds are doing whatever. Maybe I should go all into stock. Like, how should investors, especially now that, again, talking about this, Public now has an option to buy government debt, buy treasuries. What should your approach be when you're looking at stocks versus bonds?
Well, I'm an equity manager, so never ask a guy with a hammer, where's the nail.
But about bonds. You understand the point.
Yeah, no, I think it's, if you look out, and people should talk to their financial advisor, but you should have a balance of stocks and bonds based on your age and expectations and risk parameters, et cetera. But that's not what I do. We buy we deal exclusively with accredited investors and qualified institutions. We buy high quality businesses when they're temporarily impaired on the operating table and no one wants them, knowing and being able to discern between what companies would be temporarily impaired and what companies would be permanently impaired. And I can tell you, there are just, not only were there a ton in 2022 opportunities, there are still a ton in 2023. And while everyone's looking for short-term bonds, number one, you get a negative real yield. So you're getting 4.5%, inflation's still at 6%, so you lose money that way. And number two is the opportunity cost, which you never may get back. And if that happens, Paul, where you get this rally against the wall of worry, not because economic numbers and earnings are necessarily going to improve in the short term, but just like last year, we crashed 25% on the S&P, 35% on the NASDAQ in anticipation of the slowdown, discounting the slowdown that was coming this year. What we're going to start to see, we've just finished earnings season for 2022. That's rear view mirror. Now people are looking through to 2023, but more importantly, 2024, which is still at $250 on the S&P 500, which means we're only trading at 16.5 times forward. And I think there are a lot of positive things that could happen that no one's positioned for, namely with China reopening and that GDP. They've been closed for 2 years. You had 5% China GDP, second largest economy in the world. The dollar has been subdued over the last few months. That'll help S&P earnings. And I just think with the pessimism still pervasive, growth expectations are the lowest since the pandemic, lower than the pandemic lows, lower than the 2016, which you remember, lower than the debt crisis in November 2011, and lower than the great financial crisis in late 2008, early 2009. So that tells you everything you need to know. The pain trade is up.
Yeah, I remember 2016, 2018, and even more, sad to say. Hey, we only have a couple of minutes here, but let's focus on tech for a second. Airbnb had some good numbers. Roblox obviously had some good numbers. What do you think investors should expect out of the tech sector for the rest of the year?
Continued upside, because no one wants it. And, going into the end of last year, everyone was pitching what? Materials, energy, everything that had already moved, people couldn't get enough of. They were tripping over each other coming into 2023. That's what you need to be in. And then the highest quality tech companies. And I'm not talking about businesses that are losing money and promising to make money mañana. I'm talking about high quality, cash generative, quality tech companies that were completely a baby thrown out with the bathwater, that have huge opportunity and huge upside. When you look at semiconductors, which have been just on a tear since the October lows, I think we're at inventory peaks. I think that certainly there was a monster amount of pull forward demand for PCs and handsets during the pandemic, and everyone knows that. But if it's true that we're at peak inventories, then the market's going to start to discount the shortages moving, not the shortages, but a normalized environment moving forward. So you got semis, you got big cash generative tech, and the three areas that you couldn't give away at the end of the year, Paul: consumer discretionary, communication services, and technology. And what are the top three performers so far year to date? Those three sectors. And if you look at the earnings power for 2023 expected earnings, those were in the top. And guess what were in the bottom? The things that people were clamoring over, which was materials, energy, etc. So we continue to like those three groups, and there's tremendous opportunity in them.
Yeah, all right. Look, we got the closing bell here. It's 4 o'clock, but I want to ask one last. Give me one metric that you think people should keep an eye on to measure the economy.
I think that the market is telling you, the equity risk premium is telling you right now that it's below, it's at a level historically where it's now starting to price in that earnings are going up, not down, and the market is convinced that earnings are going to go down. Watch the equity risk premium. That's at levels outside of the historical norm. And watch what happens over the next few quarters as companies start to see. You just look at the transcripts, search for the word resilient, and you're seeing improvement across the board. So don't get caught up in all the commentator negativity and riding out in safety. Look for opportunity in high quality companies that have been marked down. Hold them for the long term. Deal with the short term volatility. And I think you'll be very pleased when you look 1, 2, 3 years down the road.
Where do you find that? Where do you find that metric?
Look, all you need to look at, I mean, this is not brilliant. Look at Amazon. It's down 50% off its highs. You could buy it for 2018 prices. They've tripled AWS, their cloud business. They've tripled their ad business. They've doubled their e-commerce business, and yet you can buy it for 4-year-ago prices. You look at Alibaba. This thing has been cut in two. It's off 66% off of its highs. China's reopening. They're the toll taker. This is the first time in Chinese history that they're going to stimulate on the basis of consumption versus on the basis of building bridges and cities, ghost cities and bridges that they don't need. They're going to focus fully on consumption. Alibaba is the toll taker, and their cloud business is just getting started. That's going to add 66% to operating earnings over the next few years as the digitization of China accelerates. So those are just two names that are kind of no-brainers as you look a year, 2 years, 3 years out. And then beyond that, you just want to have some exposure. Don't get caught up in the doom and gloom because, the first leg has already happened. Hope that you get some seasonal second half of February is supposedly historically weak. We'll see if that creates a buying opportunity as we look out over the next 4 to 6 months.
Thomas Hayes, Chairman and Managing Member of Great Hill Capital. Tom, thanks a lot.
Thanks, Paul.